thank you for joining us again and making your case well, as you always do. Since CFPB first opened its doors, we've had more than a decade of progress towards rooting out abuses and injustices for consumers in all types of markets, from mortgages to credit cards to payday loans. It matters for consumers. It matters for the vast majority of businesses that do the right thing, because when an honest business follows the rules, it's forced to compete with a predatory business that doesn't follow the rules. We know who's going to win most of the time. CFPB levels the playing field so that honest people don't get penalized for running a business the right way. When consumers interact with fair and transparent businesses, they make decisions. They can make decisions without worrying about scams or predatory practices. Since 2011, the CFPB has returned $20 billion to 200 million consumers. That's real money in real people's bank accounts, or it's real reductions in debt, money back in the hands of working families where it should have stayed in the first place. We've talked extensively about CFPB, how you stand up to special interests and scammers on behalf of service members and veterans. The director and I were just talking about that before we started. Protecting service members, protecting veterans is one of the most important things that we have charged you to do and that CFPB does. When we created the CFPB, we made sure it included the Office of Service Members Affairs. The first head of that office was Holly Petraeus, the spouse of a service member, someone from a family with generations of military service who understood the challenges facing service members and their families. These are families for whom service and sacrifice to our country are part of who they are. It's ingrained in them. The CFPB, with its Office of Service Member Affairs, takes on special interest to protect the bank accounts and the jobs of our service members, the veterans, and their families. Due to their steady paychecks and constant moves, service members are often targets for predatory financial companies and scammers. Every year, tens of thousands of service members come to the CFPB seeking assistance, reporting a complaint. The CFPB goes to bat for them. It works to get their money back or works to fix the problem. You would think that people in Congress would be lining up to make sure the agency could effectively do this important job. But sadly, that's not what we're seeing. Many of the same politicians who like to talk about supporting veterans and military families have spent more than a decade trying to tear down the agency that protects those workers, those service members' finances, and helps them get their money back. To be clear, financial literacy is not an alternative to the CFPB. Financial literacy is not an alternative to the CFPB. So my colleagues say, if only our service members could spend more time learning how not to be scammed. The men and women who serve our country, or any American, shouldn't need special training to keep their own money. It shouldn't be on our service members to protect themselves from scammers. It should be on companies not to scam them. That's why we need the CFPB. No other federal agency with this level of responsiveness and efficiency and the ability to take on greedy big corporations and shady lenders. It's how CFPB has returned more than $175 million to service members and veterans. $175 million. Earlier this year, CFPB took action against Title Max for violating the Military Lending Act passed by Congress by charging nearly 3 times what the statutory cap on interest rate calls for. CFPB ordered Title Max, a repeat offender, return millions to service members and their families. Whether you're a service member or you're a senior or you're a worker, the CFPB goes to bat for you. Last year, CFPB clarified that nursing homes can't go after family members for debt. CFPB works towards removing all medical debt from credit reporting agencies, something I've called for repeatedly. Medical debt can happen to anyone. It's not an effective measure of creditworthiness. It has no business being on a credit report, and consumers should not be harassed for falling sick. There are actions the CFPB takes to stop. Then there are the actions the CFPB takes to stop Wall Street abuses. Maybe that's the reason corporate interest and their lapdogs in this town hate the CFPB. The work CFPB is doing to stop junk fees is a top target for Wall Street. I think there'll be several members of the committee asking about that. CFPB's proposed a rule that the agency estimates will reduce credit card late fees by as much as $9 billion a year. An additional $9 billion to American households every year would make quite a difference in their lives. If CFPB is successful, that means $9 billion less on Wall Street profit statements. So of course they're not going to give up without a major and well-funded lobbying fight. That's always the biggest difference between most Americans and Wall Street. Wall Street has a well-funded army of lobbyists. The rest of us don't. That's why too often Wall Street gets its way and the American public doesn't. CFPB is their voice to take on the powerful special interests that cost them time and stress and money. It's why Wall Street and its allies have spent more than a decade trying to destroy the CFPB. So far, this is one fight that they have lost. I'll never stop fighting to ensure consumers continue to have a strong CFPB in their corner. As long as I'm chair of this committee will continue to fight for the work that you do. Senator Scott.
Thank you. Let me start off by saying it's certainly good to be back with the committee. I want to thank my fellow members, for their support, and specifically, in particular, Senator Rounds for all of his support during my absence. I would also like to welcome our newest member, Senator Butler, to the committee. Now, turning back to business. Just 2 weeks ago, our financial regulators testified before this committee and faced bipartisan concerns about the impact on everyday American families that these misguided and partisan regulatory proposals would have if implemented as proposed. While those independent regulators have become increasingly politicized under the Biden administration, the CFPB has a much longer history of skirting statutory mandates and avoiding congressional oversight. Director Chopra, you know these concerns well, and you've heard from me about those concerns. You've heard from my fellow members of the committee, as well as House colleagues. And yet, the CFPB is no more accountable today than it was at its inception. And I fear, under your leadership, the agency is straying even further from its mandated mission. I'll wait until they finish. I'll just let you go. Let's finish. The abuse of enforcement powers, rulemakings driven by politics instead of policy, and a lack of oversight, which only leads to less economic opportunity, have become hallmarks under your leadership. The law is clear. When it comes to consumer finance, the CFPB should consistently and fairly enforce federal consumer finance law, safeguard access to markets for consumer financial products and services, and ensure that such markets are fair, transparent, and competitive. Sadly, the CFPB's actions don't match up with this mandate. Under your leadership, the CFPB has operated in blind pursuit of additional power and has become the hallmark of government overreach to the point where I'm concerned the Bureau is doing more harm to consumers than good. That is why in July, I led a bicameral group of 132 members of Congress in filing an amicus brief to the Supreme Court, urging the court to affirm the lower court's decision that the CFPB's funding structure is constitutionally defective. When you last testified before us in June, we discussed your efforts to regulate through speeches and blog posts, your public pressure campaign on fee income, and your attempts to stifle innovation. Instead of correcting course, it seems that you have only accelerated towards the exact opposite direction of your statutory mission. Recent reporting even suggests that your agency will be releasing an aggressive fee proposal very soon. I really hope the old saying that a tiger can't change its stripes won't be true with the CFPB. And yet, we've seen that the CFPB recently proposed regulating access to consumer data by consumers and authorized third parties. As with anything, the devil's always in the details, but as this proposal advances through finalization, I hope you weigh the new regulatory costs against any benefits that this rulemaking may provide. And on top of all of that, the CFPB is even proposing new supervisory authority over non-bank providers of consumer payment apps. However, the rationale supporting this proposal ignores the real costs of compliance likely to stifle innovation. Costs that also will undoubtedly be paid for by hardworking American families. I wish I could stop there, but of course the list goes on. Your agency is even pushing for sweeping changes to regulation under the Fair Credit Reporting Act, ignoring the long-standing interpretation of clear legal authority by courts and other regulators. How do any of these costs and the costly actions actually protect consumers? I hope you help me understand your perspective on that, where we likely will disagree. I meant it when I said at our last hearing, the best way to provide economic opportunity and protect consumers is to encourage competitive markets and set clear rules of the road for participants. These principles protect our system by fostering competition and innovation rather than vilifying it. I will stand by these principles, and I certainly have experienced the benefits of having a system where the rules of the road are fair, consistently applied. As a kid who grew up in poverty and understood that the American dream was available, having access to that for the next generation of youngsters is so important from my perspective. Unfortunately, we see a common theme from the left, that somehow lower income families lack the wherewithal to manage their own affairs and determine what's best for their families without some sort of government intervention. While the federal government ought to protect consumers from unscrupulous practices, bureaucrats in Washington should not dictate what families can and cannot have simply by regulating products out of existence and pricing people out. As I wrap up, I want to address one final important topic. A few weeks ago, several reports were published about the toxic work environment and the culture at the FDIC. A few weeks ago, we talked about the importance of making sure that employees at the FDIC, where you sit on the board, have a safe, healthy work environment. I hope that you'll have an opportunity to address some of the challenges we've seen at the FDIC as well. Thank you.
Thanks, Senator Scott. Welcome back to the committee.
Thank you, sir.
Honorable Rohit Chopra has served as the director of CFPB since October 2021. He worked the CFPB in its early days, serving as assistant director and student loan ombudsman shortly after the agency opened its doors. He's also been an FTC commissioner. Welcome, Director. Thank you for being here.
Chairman Brown, Ranking Member Scott, and members of the committee, thank you for holding this hearing today. This is my 10th appearance before Congress since becoming director in October of 2021. I'm grateful to many of you on this committee on both sides of the aisle who have taken time to meet with me, provide advice to the CFPB on the challenges and opportunities we must face. There's so many of them: protecting sensitive personal financial data, dealing with big tech companies and their entry into finance, reducing credit reporting errors, preserving relationship banking, and so much more. Since I was here in June, I'm pleased to share that the CFPB has reached many milestones, like accelerating open banking in the U.S., protecting financial privacy, and just as Senator Scott mentioned, continuing to enforce the law fairly and consistently with clear rules of the road. These deliver results for consumers and law-abiding businesses, but I want to share a few observations about household financial stability and highlight some progress. Americans now owe more than $17 trillion in household debt. Outstanding credit card debt has eclipsed $1 trillion for the first time since the CFPB began tracking it. Auto loans have also grown quickly to an estimated $1.6 trillion. Our analyses have found that rates and fees are contributing to persistent credit card debt for a growing number of consumers. Americans paid $130 billion in interest and fees on credit cards alone last year, with annual percentage rates rising far above the cost of offering credit. The CFPB is taking a number of steps to increase competition here. The return to repayment for federal student loans continues to be an area we're looking at closely. Outstanding auto loan debt has also grown, given the higher cost of vehicles, especially during the pandemic, and the higher rate environment. And interestingly, auto loans are now eating up a bigger portion of monthly budgets than they used to do before the pandemic. We're actively monitoring credit performance, repossession activity, and more. And of course, residential mortgage activity has declined precipitously due to the rate environment. We do see that fees, discount points, and other costs have increased, and many people question how they will be able to refinance in the future. We're looking at ways to facilitate a lot more refinancing activity if and when prevailing mortgage interest rates subside, to ensure that the borrowers who experience any financial distress can navigate alternatives to foreclosure with their mortgage servicer by streamlining rules and procedures for servicers to offer loan modifications. Since our last report, we proposed a rule under Section 1033 to shift to open banking in the United States. We've initiated a process to improve accuracy and accountability in credit reporting, especially for data brokers. We're taking steps to address widespread inaccuracies on Americans' credit reports when it comes to medical bills. Our supervision and enforcement program is protecting both consumers and the honest financial firms who must compete against those who egregiously violate the law. In the last 2 years, we've obtained orders totaling $8 billion in redress and penalties. We're tackling junk fees that have been creeping across sectors of the economy that interfere with the competitive market. We've shifted our supervisory resources toward non-banks to account for the growing role they play in financial services, including a proposed rule to ensure that the big tech companies and other payment providers adhere to the same rules that banks and credit unions are following. In August, our complaint database reached 4 million submissions, and I'm proud of the CFPB's work in getting consumers the resolutions they deserve, often through referrals from your offices, local organizations, and much more. I want to thank you again for the opportunity to appear before you today, and I look forward to your questions.
Thank you, Director. Thank you for your ongoing work on protecting workers' hard-earned money. I want to discuss something that we've talked about privately, many in this committee have asked about. And one of the real highlights of what CFPB does is the Service Members Civil Relief Act. We passed it to provide active duty service, just generally what you're doing with service members, but specifically we passed it to provide active duty service members with the financial relief. It guarantees service members and their families a reduction in interest rates on any pre-service loans. My first question is, Director, would you say that all service members are receiving the benefits that Congress intended for them to have?
No, they aren't. And in fact, we saw the destructive impact of that years ago with the illegal foreclosures of active duty military families in violation of the Service Member Civil Relief Act. You know, with a higher rate environment, they are entitled to a 6% cap on pre-service obligations, and we do not see many of them always getting it. We estimate that fewer than 10% of eligible auto loans and 6% of personal loans to activated members of the Guard and Reserve were getting those rate reductions.
So what can financial institutions be doing to ensure that they get the financial benefits that Congress intended?
Well, certainly many of them are starting to just give it automatically. They can often know if a service member is activated, and they can do it rather than making the service member go through an obstacle course of paperwork.
Okay, thank you. I'm going to work towards ensuring financial institutions proactively check for SICRA reductions. Our service members and families should be able to keep their money, as you've continued to fight for. Thank you.
And on the Military Lending Act, we've pursued more actions and we are litigating there to go after the egregious repeat offenders. The Military Lending Act is one of the most important protections, not only to protect those families, but as the Department of Defense would share, our force readiness as well.
Thank you. This committee is particularly with credit agencies, have talked a lot about medical debt and what we do. The complexity of medical billing, coupled with the vulnerability of consumers seeking to obtain and finance medical services, creates opportunities for abusive, maybe that's the wrong word, for abusive practices by predatory medical debt collectors. Discuss what actions CFPB will take to hold medical debt collectors accountable when they attempt to collect bills that are not owed or engage in other unfair, deceptive, and abusive practices.
Well, we've already been taking some actions on the enforcement front, but there's going to be more. We've conducted quite a bit of analysis about medical debt. And you know, this is not like a normal loan. You don't sign up like a credit card or a mortgage. It happens to you, and then often a bill is put on your credit report, even if you've paid it, even if the insurance company has covered it, and you're stuck in the middle. Many people end up just paying it to get rid of it, and we are exploring whether it's even appropriate, given the widespread inaccuracies with credit reporting, whether it should be on credit reports at all. many financial institutions will tell you that data is often not even predictive at all, and it should not be used to coerce people into paying something they don't owe.
So walk through. I mean, when we've had the three major credit agencies in front of this committee, we've done it 2 years in a row. It's a practice we started and will continue to do. Talking especially, one of the main topics has been medical debt and what it does to consumers, as you just explained. Some 10 million Americans have had their credit histories harmed by medical debt. Talk more specifically, and then my last question about walk through what that rule, what you are working on to fix that. If we can't get the credit agency to do the right thing, they've taken steps, but not enough. Tell me what you would do.
So the three credit reporting conglomerates have already taken steps to remove certain amounts of the debt. We are proposing or exploring rules that would limit credit reporting of certain medical bills. We're collecting feedback from small businesses right now about it. We've been talking to the medical industry, hospitals, medical debt collection, providers, and we may, although we have not made any firm conclusions, propose a rulemaking to restrict the reporting of medical bills on credit reports.
Thank you, Director. Senator Scott.
Thank you, sir. Last month, the CFPB announced that it was proposing to expand its own authority to supervise technology companies, a move that should be called out for what it is, another attempt to stifle financial technology and financial innovation. I firmly believe innovation in finance has made it easier for lower-income families to access financial services, such as basic checking and savings accounts, as well as even more complicated products like mortgages. Private sector competition and new innovative technologies can bring financial opportunity to all Americans. While new technology needs appropriate supervision and guardrails, American innovation should be encouraged, not crushed by bureaucratic red tape. And yet the CFPB ended its financial innovation sandbox, which offered safe harbors to firms attempting to further democratize finance in a safe manner. While I understand the need to ensure consumers are not targeted or taken advantage of by bad actors, what rationale supports preventing responsible, well-regulated companies from releasing new products within the confines of a safe harbor program?
So let me address everything you've said. So first of all, let me just share, you said something earlier that I totally agree with, that the competitive markets really deliver a lot, especially when there's clear rules of the road that are consistently enforced. I actually am a huge believer in the role of technology to really bring a lot of benefits. It's why we proposed our open banking Section 1033 rule. But you mentioned oversight of the large tech companies, payment apps. We are not expanding our authority. They are currently subject to our enforcement authority. And I think in our judgment, rather than resolving issues through litigation, we should look at those large firms serving tens of millions of people and make sure that they're following the law just like small banks are doing. Supervision of non-banks and banks is a key way that makes those laws consistently enforced. So I'm trying to make sure that where we see fraud, and there is on some of these payment apps huge amounts of fraud, where we see collection and surveillance of data, we need to make sure that it's compliant with the law. But I totally agree with your question that we want firms to be able to get products out to the market if they're with the right guardrails. And you ask about the safe harbors. We conducted an analysis of these special no action letters. And here's what we found. Some of the companies receiving them claimed that they were endorsed by the government or that they were the exclusive provider. So what we've done is we want some of those programs to be applicable to lots of organizations, not just crowning one member of the industry. That's really what competition is about. It's not about picking winners and losers, sir.
Well, I certainly wish that were true for the government, but certainly our government, particularly the Biden administration and particularly the CFPB, seems to want to pick winners and losers. I mean, as a guy who was in business for several years and started several businesses from scratch, the one thing you need from your government is not competition, it's certainty and predictability. When you set the rules of the road, step back and give the market time to actually absorb the changes, innovate, be creative, take the calculated risk, and come to a conclusion whether it works for the business. If it doesn't work for the business, it's because the consumers are not benefiting from the product or the services in the marketplace. When that happens, the brilliance of a free market system works. When the oppressive nature of your agency and the Biden administration comes in and starts tweaking the rules of the road, as you would suggest, thousands of fintech firms working in the marketplace, and some, that could be 5, it could be 500. I'd love to see what that list looks like from your perspective, but the reality of it is that when you have an opportunity to engage in a free market system with the rules of the road without the government being oppressive and stifling innovation, then the consumer benefits. If you want to have access to more opportunities for the poorest Americans, the way that you get there is by having a framework and a playing field that doesn't discriminate. Well, the beauty of the financial technology innovation engine is that you have more people accessing more products, more services with an app. That's what brilliance looks like. But when you have,
And I agree with everything
let me
you
finish.
just said.
But when you have the uncertainty brought to the marketplace by agencies, the challenge that we see is that the ROI goes down, the cost benefit analysis goes up, and so players in the market space, they leave. And what that leaves poor families to do is to go into brick and mortar only and make decisions. There's just a better way, and hopefully we'll have a second round to get some more questions.
Thanks, Senator Scott. Senator Reed of Rhode Island is recognized.
Well, thank you very much, Mr. Chairman, and Director, thank you, particularly for your support of the Servicemen Civil Relief Act. I think Senator Brown's questioning is right on target. And you're right, it does contribute to the readiness. As someone who served for 12 years in the Army and had to deal with these issues as an executive officer, you have to be on the guard constantly against lenders who don't respect, except in their advertising and in the multiple flags they have on their property, but they don't respect the soldiers as much as they should. So thank you, and please keep it up. By the way, when I was on active duty, it was called the Soldiers and Sailors Civil Relief Act, but then with the end of the Civil War, they changed it. I'm joking.
Yes.
No. Sorry.
I got it, Jay.
No, sorry. A little levity. Credit rating bureaus sell so-called trigger leads, which are essentially a tip that a consumer is shopping for a mortgage. The trigger lead can generate hundreds of contacts, and some of them more confusing than helpful. And you have a responsibility for both the mortgage lending process and also the credit reporting bureau. Is there anything you could do to help clear up the situation under existing authority to protect consumers from misinformation and just a deluge of...
So one of the things that a prospective homeowner will talk to a mortgage lender, and then all of a sudden they'll start getting a barrage of calls, and they actually think that the original mortgage lender told everyone, and they wonder what's going on. This is something that I think our authority is somewhat limited, but I think we're happy to look at different solutions to make it clear that, you know, that is not happening because the mortgage lender is really telling everyone. It's because the credit reporting company is really making that information available. You know, you raised the issue of SCRA and data on credit reports. We have a lot more of these companies collecting sensitive information, not just what loan you apply for, your geolocation, you know, where you go, and that data is increasingly being weaponized. And so we're looking at all of these data issues and figuring out how to make sure we're protecting the public.
Well, a simple approach might be to, and this would require our action, is to give the consumer the right to erase all the data or only hold it for
A period of time.
limited period of time, or prevent the sale of data with some exceptions. But we have to think about that as more of these situations take place. Buy now, pay later is becoming very popular. And we are now seeing that essentially the regulation is state-based. I think there really is a area of responsibility that your bureau could assume in order to make sure that this buy now, pay later situation does not, you know, really hurt the consumer as it could. Any comments or thoughts on that?
Yeah, I agree. We issued a report with a number of actions. We've started acting all that, including supervision of some of these firms. I've been checking day to day when it came to Black Friday, Cyber Monday, what is happening with the growth on buy now, pay later, and I hope to report more to you about that. The bottom line on this is there's a lot more buy now, pay later providers. We cannot have a race to the bottom. We have to have some basic standards for which they will not try and use regulatory arbitrage to cheat people. They too are also harvesting quite a bit of data, and we need to look. We're going to be looking at that. So I want to make sure that whether you use a buy now, pay later loan or a credit card, that federal you can have your federal protections and it's not arbitrage.
And I think what would be helpful to us if you could generate some information about the insidious use of this data that's collected, because I'm sure there's some very graphic examples. And what that would give us, I hope, the motivation to give you the authority to take appropriate steps.
Well, I worry that actually state and non-state actors are going after this data. We saw with the Equifax data breach that it ended up in indictments of members of, the Chinese army. So we have to look at this not just as consumer, but really our data and our security.
Thank you very much, Mr. Director. Thank you.
Thanks, Senator Reid. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Director Chopra, welcome. Let me just begin by talking a little bit about Regulation Z. Overdraft protection helps consumers in making ends meet when a deposit account balance is low, particularly for those consumers who are unable to qualify for traditional credit products. News broke this week that the CFPB would soon be releasing its much-anticipated rulemaking on overdraft protection. When the Federal Reserve constructed Regulation Z almost 50 years ago, it intentionally excluded overdraft because it was clear that applying the Truth in Lending Act and Regulation Z to overdraft would be impractical. However, the spring 2023 Unified Agenda indicates the CFPB intends to do just that. When will this rule be published?
To be clear, that's not what the regulatory agenda says. We're looking at what the Federal Reserve did many years ago in the era of paper checks and mailing checks. We have not made any conclusions, but I am hoping we continue to get industry feedback that they'd actually like some clear rules. I don't have an exact timing on it, but I will share this. I agree with you that people need to be able to access liquidity, with respect to when they have a deposit account shortfall. There's lots of ways we're looking to address that. And in fact, borrowing is really how families and businesses survive. So I do want to assure you there is not an effort to eliminate or make that need not able to be fulfilled.
So
but
at
again,
this
we
point,
have not proposed a rule yet.
There is not a rule that you're anticipating releasing with regard to.
Well, we are working on something, and I think what we're trying to address is a number of issues that if you look at some of our past work on this, there's certain data and enforcement work where we reached an enforcement action with Regions Bank and Wells Fargo where some of it involved moving around the payments in order to generate not one overdraft fee for the day, but sometimes 4. So we have to address the harms while still allowing consumers to be able to access the liquidity when they have a shortfall.
I guess the reason why I bring it up is number one, you've released data that indicates a major reduction of overdraft fees over the last several years. In fact, overdraft revenue in the fourth quarter of 2022 was 48% lower than overdraft revenue in the fourth quarter of 2019. It just seems to me that as a part of any study that you're doing before you release a new rule, I would hope that you would look at whether or not, if you decided to do something on it, whether or not it would actually limit access to overdraft protection if it is subject to Regulation Z's requirements and the impact that that would have on consumers. I hope that that would be included in any proposed rule that you may very well come up with.
Well, let me share with you, we actually do see quite a bit of differences between the relationship banks and the non-relationship banks. I do want to commend a lot of the banks for the industry for really starting to compete now on overdraft. Many of them are showing their lower fees or the buffers they're provided. So I agree with the spirit of everything you said, and we're continuing to work on it.
You mentioned earlier the issue of medical bills and whether or not they should be included in a report, or at least if someone is identified as not making a payment on one. As a part of your analysis, are you looking at how the healthcare industry is responding and what they're doing if the folks that normally would be the collection services for them, if they can't put that on the report? It seems to me that there's a possibility that some of those healthcare providers who have to pay their bills too may very well look at cash only or payment up front on some of those services that these folks may not be able to afford. Will that be included as a part of the analysis that you do?
So we've been talking to a lot of players in the market. There is a heterogeneity. We see a lot of places don't do reporting. We see some that do reporting. We do have very serious concerns about inaccuracy and coercion. And I think that's really a big problem. But I'm pretty sensitive to the issue you said. For what it's worth, we do see a lot of the healthcare industry already shifting to, a credit card up front. And I think that some of those are issues that are really outside the scope of the CFPB. But it's certainly something we're looking at very carefully to determine how we proceed with this.
If it makes it more difficult for them to collect on a bill, some of these folks who don't want to are looking at this saying, look, if we can't get our bills paid, chances are we're going to have to take a different approach. And that puts a bigger burden on some folks that probably can least afford it. And I would simply hope that if you do any rulemaking on this, that you take that into account and are able to share that with this committee.
And I'm happy to discuss with you further because we want to get it right.
Thank you, sir.
Thank you, Senator Tester of Montana is recognized.
Yeah, thank you, Mr. Chairman. I want to welcome Senator Scott back to committee, even though Rounds did an outstanding job. He's no Tim Scott, you know what I mean? And I would also say that I'm sad that you got out of the race because I think you're fundamentally a good man. And
Thank you very much.
And we appreciate your efforts.
Well, you'll serve in one of my future administrations.
Oh, sure, yeah, absolutely. And I also want to apologize because Senator Brown and I were talking about China Iagland when you were giving your open statement. We've got some issues. This is a bill that Rounds and you're familiar with as well as the chairman that comes out of this committee. Exactly. And just to release a little frustration I have, there are some over in the House, a chairman in particular, that doesn't think the Chinese Communist Party is a threat to this country. And that bothers me a lot. And I visited with the good senator from South Dakota on this already, and we'll figure out a path forward. But the truth is that John, it's better to deal with stuff before it happens than afterwards.
Yeah, I appreciate that, John. I appreciate your apologies. I hope that your chairman is kind enough to you to extend a little extra time to you. I know how hard he is to deal with sometimes. So
he's
he gives
I will
you
always give
seconds.
extra time when people say nice things about Tim Scott.
Oh, so exactly. He's a tough
You just
character.
can't help it, do you?
Director Chopra, thank you for being here. I appreciate your work. I chair the Veterans Affairs Committee. I've been working with Chairman Brown to protect the folks after they get done with their service to the country, the veterans. And we've had an issue with home loan guarantee benefits and veterans losing their homes due to foreclosure. The VA took quick action. I applaud them for that after we sent a letter off on the VA home loan issue. And hopefully they're able to work for a permanent solution moving forward. But I'm concerned about how these folks got into the situations to begin with. We need to make sure that our veterans, their service members, as Chairman Brown said, and their families are being served in the right way by the VA, by the lenders, and by the mortgage servicers. So Do you know if this is something the CFPB has been hearing about from our veterans and our service members?
Yes, and in fact, if you'll recall, we had some things that rhymed with this many years ago with the VA home loan churning with refinancing. And now I also want to agree with you. I'm happy the Department of Veterans Affairs, the actions they're taking. The VA home loan program is enormous. It's critically important. But of course, we do see bad actors targeting beneficiaries.
And what tools do you have to stop that?
So our authority is really on the lenders and the servicers. So we have to police for our laws, but of course, the Department of Veterans Affairs, we work with them on their program guidelines to make sure that the homeowner is protected. And I will tell you, a wrongful foreclosure of a veteran, especially an older one, it's a very, very devastating consequence to deal with, and we're looking at ways to prevent avoidable foreclosures like that.
Thank you for that. Last month in the VA committee, we had a hearing on financial protection for our veterans and their families and discussed ways that folks in our military community, our veterans, have been taken advantage of. And the responsibility that the VA has, that the CFPB has, that the FTC has to protect them. Just for a little background, there are accredited veteran service organizations out there that help veterans access their earned benefits. But there are also a growing number of organizations trying to take advantage of our veterans for money. This always tends to be the case when you have a steady flow of income into a community. A lot of this, I believe, is in your bailiwick, like watching the companies trying to collect on debt related to unaccredited VA claims consultants. Number one, is this on your radar screen? Number two, what trends are you seeing?
Yeah, so in our regular sessions that I participate with our VSOs and military family advocates, the unaccredited consultants, I think a major way they're getting in is often through social media advertising. And I think we have to figure out how they are using, TikTok, others to reach those veterans, make claims. I worry about how we will be able to detect perpetrators there, but it certainly is something of ongoing discussion in our Office of Service Member Affairs in the VA. And I have to be honest with you, I think it is going to maybe also need to involve criminal law enforcement.
Okay. One of the things that crossed my mind during the hearing is, are we seeing the cases of these folks being taken advantage of more prevalent in the veterans community or the active duty community, or is this stuff happening regardless, that there's no difference between those two?
Well, generally speaking, I think you will see more in the veterans community because there's often a target of a government benefit. So that is a place that people, will see dollar signs.
Yeah.
And immediately go after it. In many ways, it's pretty easy to identify a military family or veteran, often through social media and the data broker world that now exists.
And I think you've already touched on this, but I want to flesh it out a little more. What do you see as the biggest risks that the CFPB can help with as it applies to the financial solvency of our veterans?
Well, certainly, I think home ownership and being kicked out of your home and being able to get a loan modification by sheer dollars, it's a huge amount of money. And that's why we're looking at streamlining some of our mortgage servicing rules to allow more people to more easily get loan modifications and be able to avoid foreclosure.
Okay. Thank you.
Thanks, Senator Tester. Senator Vance from Ohio is recognized.
Thank you, Mr. Chair. Thanks, Mr. Chopra, for being here. So I want to talk about a couple of issues, one of which is the Department of Justice and CFPB's joint statement effectively discouraging banks from asking about immigration status in loans. And here's what worries me about this. So first of all, of course, we have a historic human and drug trafficking crisis on the southern border. I worry about the Biden administration effectively signaling to banks that they should make it easier to lend to folks who have come into the country illegally, and I worry that could frankly exacerbate the crisis that we already have. The second point that I make on this is just if I look at this from the perspective of a bank, it seems totally plausible and reasonable to me that if you're lending to an illegal alien, that is maybe a riskier loan than lending to a legal alien or a citizen of the country. So just to sort of strongly discourage you guys from going down that route. And I think we should try to make it easier maybe for the financial system to discourage the immigration crisis that we have before us. I actually wanted to ask about a separate question. I know, Mr. Chopra, you share some of the concerns that I have about the concentration in the financial system. And, I still don't think the American people have gotten a full accounting and understanding of what happened with the Silicon Valley and First Republic bank collapses. And I want to kind of lean in there and maybe just start with the very basic question of when First Republic was acquired, we've heard a number of different arguments or a number of different claims publicly and privately about what the spread was between the PNC offer and the JPM offer, which eventually was, of course, the successful offer to buy First Republic. Are you willing to tell me on the record what was the spread between the JPM offer and the PNC offer?
There were multiple bidders.
Of course.
I don't know if I'm permitted under law to say the specifics, but let me just say this, which is that JP Morgan Chase's purchase would have ordinarily been completely prohibited by law.
Yep.
That was not a decision of the FDIC. The FDIC had to look at what the least cost was. And there was a determination that JP Morgan's bid was higher. And then that went through bank merger review by the other agencies. But we'll try our best to give you more information on the multiple bids.
Yeah, I'd appreciate that because, one claim that I've heard is $20 billion, right? A spread of $20 billion is significant. And obviously we want to minimize the risk to taxpayers and to the depository insurance program. I've also heard the claim of $1 billion. And if the difference between the bids was $1 billion, that seems like a small price to pay relative to the massive concentration problem raised by First Republic going to the largest bank as opposed to a significantly large but still fundamentally regional bank. Let me sort of ask this question, Mr. Chopra. Let's say, understanding you can't give me an answer right now, and I would appreciate you following up. If the spread was $1 billion, do you think that raises some pretty significant concerns about how that bid and purchase process unfolded?
Well, yes, although the statute as written does require the FDIC board to accept the least cost, but of course, the Federal Reserve Board, the other regulators, they have the ability to disqualify under the Bank Merger Act.
Right.
So I think that's really the two pieces, and we'd be happy to share with you how the statute could be tweaked to avoid this.
And I appreciate that. And just the last question here. So you mentioned this earlier, but FDIC Chair Grunberg waived the requirement that would effectively cap any purchaser from putting the financial system at a situation where a single entity contained more than 10% of national deposits.
No, the FDIC cannot waive that. That's the other regulators.
That's the other regulator. Okay. Thank you. Could you? Well, let me put it this way. Did you have any concerns with waiving that requirement? Recognizing that wasn't your decision, do you have concerns with waiving that requirement?
Well, certainly, I think you've talked about the trade-offs between the cost to the deposit insurance fund and how the increases in concentration should be weighed.
Yeah.
I personally have great worries that the largest institutions, if they're able to scoop up all the failed institutions, even when there's other bidders, it raises some real issues.
Great. Thanks, Mr. Chopra. Thank you, Mr. Chairman.
Vance, Senator Menendez of New Jersey is recognized.
Good to see you, Mr. Chopra. While some banks have either decreased or eliminated overdraft fees altogether, in large part due to increased scrutiny and oversight, banks still collected an estimated $7.7 billion in 2022 in overdraft and non-sufficient fund fees. Furthermore, a recent report from California state regulators showed that 30 credit unions earned half or more of their net profit just from overdraft and NSF fees. Director, who typically pays for the expensive overdraft fees that banks and credit unions charge?
It's typically families who live paycheck to paycheck, the lowest income.
So from your perspective, what can be done at the CFPB to rein in these excessive fees?
Well, we've taken a number of actions on the enforcement side, supervision. We are also looking at where there may be rules to rein in some of these abuses. At the end of the day, we know we'll want people to be able to access credit, but sometimes it is not subject to the normal competitive forces, and they can really be gouged. And so there has been many institutions that have shifted. The vast majority of institutions, I think, are doing a good job, but there are many bad actors that we have to deal with.
So you are considering a rule?
Yes.
Well, overdraft fees are one major reason why so many Americans are still hesitant to enter the formal financial system. So I look forward to what you do in this regard. I was pleased to see the CFPB's proposed rule earlier this month establishing supervisory authority over large non-banks with person-to-person payment apps such as Venmo, PayPal, Cash App, mobile peer-to-peer payment applications, which are growing ever more popular and are expected to facilitate transactions worth over $1 trillion this year. You and I and several other members of this committee have spoken and written letters about the rampant scams and frauds on these apps, as well as the difficulty consumers can face in being made whole as a result of these activities. Can you explain how the proposed rule will make these apps more secure and protect users?
Well, we've seen a number of issues with these big apps. You mentioned fraud, but there's also very significant data collection occurring on them. In many ways, it resembles what we see in China with WeChat Pay and Alipay. So we proposed a rule to be able to supervise them for these existing federal laws. No new one, there's no expansion, and we think that that will help level the playing field and make sure that these consumer payments companies operating outside of the banking system are protecting consumers the way they ought to be under federal law.
Well, I look at the rule as an important first step in creating a fairer and more secure digital payment ecosystem, and I look forward to your continued work in this regard.
Well, thank you so much. And as I've mentioned with many of you, we are also thinking about how these apps are trafficking remittances. And I think we'll continue to look there to make sure that those sending remittances get a low competitive cost and they have the same consumer protections.
Let me turn to student loan repayment, which has restarted. Borrowers have experienced a multitude of issues with their services. I've heard from constituents who have noted extremely long wait times to hear from a servicer representative and incomplete and unhelpful information from automated systems. On top of that, millions of borrowers have been moved to a different servicer. Earlier this year, I sent a letter to the Department of Education asking that they get answers from Moella, the servicer who manages the Public Service Loan Forgiveness Program, regarding the issue borrowers were confronting with a return to repayment. Given these and many more issues, I'm pleased to see the CFPB open an investigation into Moella, Nelnet, Ed Financial, and Aidvantage's customer service practices in October. Can you speak more to what the CFPB is doing to hold student loan services accountable and support borrowers?
Well, we know that many of the servicers during the pandemic made a business decision to lay off or to otherwise, no longer employ a number of employees. They now are ramping up, and there has been issues where people are experiencing very long wait times or getting incorrect bills. I can't comment too much further other than to say we are certainly working with the Department of Education and the states to address any violations of law.
Well, the repayment process has begun. It's hitting many heavily. Getting the right answers and being able to speak to a servicer that actually services you is critical. Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Hagerty of Tennessee is recognized.
Thank you, Mr. Chairman. Welcome, Director. Three quick things to cover with you. First is looking at the recent brief outline that you've released on the FICRA rule. Some of the changes proposed strike me as particularly aggressive, and it's unclear how they can be justified as necessary or appropriate as the law requires. First, the outline uses a new term, data broker. That, as proposed, would significantly expand what constitutes a consumer report and consumer reporting agency, but it doesn't reference or explain the specific FICRA authority for this expansion. Second, the outline states that the CFPB is considering a proposal to, quote, clarify the extent to which credit header data constitutes a consumer report. And given the longstanding recognition by both Congress and the FTC that this data does not constitute a consumer report, they've always been treated separately in legislation, it's puzzling to me how such a drastic change of course is necessitated, particularly when you think about how that putting limits on credit header data would have serious impacts on community lenders' anti-fraud efforts, and it would seriously hamper law enforcement's ability. You may have seen the article in the Wall Street Journal yesterday from an FBI agent who used credit header data to block a terrorist attack. Can you explain to the committee specifically what statutory language gives the CFPB the authority to make these changes to the FICRA?
Sure. It's in the Fair Credit Reporting Act, and let me give you some more context. So data brokers, there's some of the same types of firms that Congress was concerned about when passing the Fair Credit Reporting Act, assembling very sensitive dossiers about each of us for sale. And I think it's not just for sale to commercial companies, but to even foreign agents. So we want to make sure that the business models that exist today, we are providing the appropriate clarity rather than just doing law enforcement
I
investigation.
want to make sure that there's clear regulatory authority too, and I want to make certain that you take into account these areas of concern.
We will, and I'm happy to discuss it with you, and we will share with you specifically, if we do propose a rule, the actual authority for which we would probably.
Let me turn to a different issue now, and this is deeply concerning to me in my home state. Prior to the release of the Basel Endgame proposal, which as a member of the FDIC you voted on, a letter was sent to the heads of the three regulators in charge of this proposal by a number of groups, including the NAACP. They were concerned about the impacts of this rule on credit availability, especially to less affluent Americans. In their letter, they say, and I'm going to quote this, quote, such a significant increase in capital standards will lead to reduced credit availability for all types of lending and undermine economic growth. If these standards are adopted, they'll have a devastating impact on our efforts to increase black ownership and disadvantage all first-time and, in particular, first-generation homebuyers who do not have the benefit of multi-generational wealth or higher-than-average incomes. Do you agree with these concerns, Director Chopra, and what would you intend to do about it?
Well, let me share with you long-term. One of the things that was so devastating to those underserved communities you mentioned was when there was a financial crisis because banks held inadequate capital. A financial crisis.
So you're talking about raising capital, making that capital unavailable. We've been through the financial crisis. We've been through re-regulating after the financial crisis. We've been through a stress test like we've never seen before with the pandemic. You're talking about taking capital away from this group.
What we're trying to do is avoid bailouts, avoid massive taxpayer
and
rescue.
at the same time depriving first-time owners, black American homeowners, my constituents
what we're
in
doing
Memphis,
is
Nashville,
we're collecting
Chattanooga,
comment.
Knoxville are not
We're
going to have the
collecting
access.
comment on that, the three bank regulatory agencies, and I can assure you I will personally look into that issue because
I
there's
appreciate that
nothing I
assurance.
would want to see. I want our financial system working to serve everybody fairly.
As do I, and this cuts against that very clearly in my mind. Last question for you, Director Chopra, and this is a grave concern to all of us in terms of the competence that's being demonstrated here or not being demonstrated, and the lack of confidence that the American public has in our agencies. In April, the CFPB notified Congress of a data breach. From within the CFPB, this data breach occurred where over 250,000 consumers' personal data was sent to a staffer's personal account. That presents a massive security risk, and it also really endangers the public's confidence in your agency. So I'd like to give you the opportunity to update us today on what has taken place there. Was that person compromised by any foreign authority? Was the data sold or transferred?
Great.
Can you give us assurances that that hasn't happened?
Yes, so the insider threat issue was extremely serious. That employee is no longer working at the CFPB. We've taken a whole host of steps to figure out how it should never recur. Consumers have been notified, but I can
Was the data
confirm
sold or transferred? Have you been able to get to
Well, we're working with all appropriate law enforcement, but I have no evidence to suggest in any way that it was related to a foreign agent or intelligence operation. We have
You can see the threat I'm concerned
Oh,
about.
of course. I mean, I worry so much about insider threats because there is data across our ecosystem in online and others that can be misused and abused, and we take it very seriously.
I think you should. The confidence of the American public is critical here, and I think we continue to see it erode when we see mismanagement like
Well,
that.
thank you for raising that.
Thank you. Thank you, Mr. Chairman.
Thanks, Senator Haggerty. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Director, it's good to see you again. I want to raise an issue I don't believe has been raised today, and that is how you're thinking about artificial intelligence. And let me acknowledge, as I've had in this committee before, I can't think of a topic that is less linear, at least with me, in terms of the amount of time I spend doesn't mean I'm getting any smarter on this. It obviously is changing everything around us. I particularly sit from my perch as chairman of the Intelligence Committee, looking at some of the national security risks. I think there are huge risks in terms of discrimination. I want to give a shout out to Lisa Rice and the National Fair Housing Alliance, the good work they've been doing on making sure some of these AI tools don't
Agree.
Add to discriminatory practices. Where I've talked with lots of members on this committee are two areas where AI, not in terms of next generation, but in today's generation tools, could have dramatic effect in undermining public confidence. One, all of us as elected officials, I think immediately get is potentially undermining faith in public elections. The other, though, is public trust in our markets. And candidly, I've been surprised that we've not seen more massive use of AI tools beyond kind of deep fake tools to manipulate our markets. And this can happen at such scale and speed using AI that it is could have dramatic effects. I know you've been thinking about this a lot as well as you've kind of gone down your own self-learning path. How are you thinking about framing any sense of guardrails around AI as we think about public trust in the public markets?
So I think of two vectors this could occur. One is where there is extremely opaque AI that magnifies disruptions in a market that turn tremors into earthquakes. We actually have seen some of this in the past with high frequency trading and securities, but I could see it being dramatically magnified, particularly if many firms are depending on the same foundational model, which is likely to, I think, potential to occur. The second is a deliberate use of mimicry of human communication or other ways of fakery and fraud to create a financial panic at a particular financial institution or at a financial market utility, an exchange. There are many ways this could happen, even a credit reporting agency. I think we have to look very hard about the financial stability effects of this, because this may not be an accident. This may actually be a purposeful way to disrupt the U.S. financial system, and we should look at it with that mindset.
Although I would point out, and this is one of the things I've been wrestling with and talked to some of my Republican friends on this, is, you know, a lot of times in terms of market manipulation in our existing structure, you come back to intent. But I would argue that you could have some of these AI tools that someone could hide and say, I had no intent. I simply told the tool to make money. And if the process of making money led to
blowing up the system
or creating fake accounts, so what level of liability, even if there's not proven intent? Have you thought about that?
Yeah, well, it's one of the reasons why the U.S. has always had, for over a century, prohibitions on things like deception, unfairness, that have multiple prongs, but don't necessarily require intent, because you can create a huge amount of harm. And we want it's in some ways like data breaches. You've put some obligations on firms to make sure they're secure to stop the downstream harm. So I share your view that intent-based standards will be almost useless when it comes to certain uses of generative AI.
One thing that we've been working on, again, in a bipartisan way, is using one of the tools created by Dodd-Frank that I think has been, candidly, its record is a little bit mixed in terms of FSOC. The notion that, how do you get the regulators looking beyond their individual area to look across the whole system? And boy, if there was ever something that seems tailor-made for an FSOC examination, I know we've shared some of our ideas with you guys. What got any thoughts on?
Well, I agree with you. I do think that the entry of big tech companies into finance and other large pools of data, as well as the use of advanced computational models and generative AI, including in the cloud, I think that's very worthy of the FSOC to look at whether it needs to use any of its tools. I take seriously the concern from many of you that the FSOC has become, over time, a book report club rather than using the tools that were passed into law to protect the system.
Thank you, Mr. Chairman.
Senator Warner, Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Thank you, Director Chopra, for being with us today. Number of questions that my colleagues have already hit on, but wanted to start with one that I asked some of the bank regulators before this committee a few weeks ago. And I asked them whether they believed our banking system to be strong. And every one of them said yes. And so my question to you is, do you agree with them that, in your opinion, the U.S. banking sector is strong?
Yes, I think it is a strong system, and one where we occasionally see some places where there could be resilience issues. Senator Warner just mentioned one of them, but certainly we always have to be looking to ensure that resilience.
Yeah, and I appreciate that all of you believe that. In my opinion, I look across the board, I look at some of the new rules, I look at some of the new implementations, and in my opinion, while everyone says it's strong, I feel like we're doing things simultaneously that are actually going to weaken the system overall, and particularly for the end user, particularly for the small businesses, particularly for everyday average Americans. And so I'm concerned by what I've seen, both at the Fed, at the FDIC, which I hear you play a significant role in, and at the SEC. So there are countless examples of regulators reaching beyond the mandates that we have given and seem to be rushing into very complex rulemaking, not thinking about how these things work together and then what that impact overall is going to be. And I believe it will be detrimental to our economy. And more importantly, when I'm looking at the people that I represent, I think small town Alabama is going to pay the price. So I want to start with the 1071 rule. So community banks provide over 60% of small businesses' credit needs, and that is nearly 2/3 of all small business loans. And to give you an insight into me, both of my parents were small business owners, so to me, this stuff matters. These banks offer a reliable and available source of credit to all of our small business community, and I am sure that you agree that you want to see those people thrive as well. So, Mr. Chopra, do you believe that this rule, as currently written, will help support small banks' ability to continue being the primary lender for small businesses?
Well, I want to make sure I share your view that we want local banks to be able to provide small business credit to everyone.
Do you think that this is going to continue to
Well, let me share more, which is that we do know that there has been a lot of questions about who is getting small business loans, who isn't, and that really undermined PPP. So we were under a legal mandate, a court order to complete the rule. We exempted, I believe, an additional 2,000 banks from it. We reduced the number of data points.
And so court orders do matter to you. So what the Supreme Court says goes, kind of thing.
Of course. But we were also sued because the rule was not complete a few years ago.
But real quick, when you're talking about this rule, you've said that you're going to post these things online, if I understand correctly, some of the findings that you get from this expansive rule.
So just like the Home Mortgage Disclosure Act, there is going to be analyses of the data.
So will it be so where we could tailor it down to who in what community, how many people are asking for certain loans, who got them, who didn't?
Well, certainly we cannot allow it in any way to identify a small business owner.
Right. So that's my question. So will it be broad brush, or will you say in Franklin County, Alabama, this is who got it and this is who didn't?
Well, that sounds way like it could re-identify. So here's what we've outlined in the rule. We won't be able to post things for probably years. We'll look at the data and we'll go through the process of making sure that we're publishing analyses. Many of them may be aggregated at the state level, regional
So you're
level.
saying that you won't, because you're from, is it Plainville? Is that right?
No.
No, where are you from?
I'm from outside Philadelphia.
Outside of Philadelphia. And so how big of a community is that?
It's a pretty large metropolitan area.
So I just think to this, and it's interesting to hear you say it'll be years, because we have small community banks that are struggling with how they're going to do this, and they serve a community of 3,000 people, Red Bay, Alabama.
Well, then that wouldn't be published then, just like the Home Mortgage Disclosure Act doesn't publish
because there's
that.
certain things that you're asking for that it goes from protecting a consumer to invading their privacy.
Yeah, I agree with that.
And then-
You do not want,
so you
especially
promise that-
demographic data, to
Exactly.
be published that way.
But then, so you're saying you'll request it, but you're not going to publish it.
Well,
right?
There's often data that is used by law enforcement in order to determine
And
that the laws
I only
being
have 10
followed.
seconds. I'm so
So
sorry.
that's why, if you can let me finish, I don't want there to be
If you'll
any
let me ask
sense
one more question.
that we're going to publish kind of and identify individual borrowers.
Great, because in 3,000 people, it's certainly
Agreed.
100% would, and I think that is a deterrent. My question, the last question that I wanted to ask you was about community banks. Have you sat down with community banks to talk about the implementation of this rule and what they believe it means, or NFIB, small business owners? Have you done that?
Yeah, so I've actually met, I believe, with community bankers from every single state represented on this committee. I think we've met with maybe over 1,000 in small group meetings to talk about all the issues.
Okay.
We are actually most small banks, so you're aware, will have a much delayed implementation date. The large banks will go first, and we've devoted some
Yeah,
real
because the
resources
small
to
banks
that.
don't have the resources
I
to do this
agree.
kind of stuff. And if you have not met with Alabama community bankers, if we look at this and you have not, will you sit down with them for
Of
me?
course.
I-
I think we may have met with Alabama credit unions, but we'll check, and please help us organize.
And I would
it if
love
we
for
have
them to have a face-to-face with you. Would that
Of
be
course.
okay? Okay, thank you.
Thank you, Senator Brett. Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So I want to talk about junk fees. Americans are getting hit with junk fees over and over and over. Try to book a flight or rent an apartment or buy a home or pay a phone bill, even pay off a loan, and consumer can get hit with junk fees. I'm really glad that the Biden administration has made eliminating junk fees a central part of its agenda to try to lower costs for working families. And the CFPB is on it. You have already forced big financial institutions to cough up $140 million in refunds on junk fees, mostly on overdraft charges. And now the CFPB is taking on credit card late fees. Now, nobody picks a credit card because they know how much the company will charge if you're 2 hours late getting your payment in. But those junk fees can really add up. Credit card late fees run as much as $41 for being even 2 hours late, and it gives big payoffs to these credit card companies. Last year, the junk fees scooped up more than $14 billion in late fees. Now, the CFPB says it's fine for credit card companies to make customers pay additional collection costs on late payments, but they can't use late fees just to boost company profits. That's gouging. CFPB says that if a credit card company is charging more than $8 in late fees, the company's actually going to have to show its work. That is, show that it costs the bank more than $8 to deal with these late fees. Otherwise, $8 is the most that they can charge. Now, the banks have responded to this proposed rule with their usual approach, howling about regulation and unleashing an army of lobbyists to swarm Congress. And why not? After all, there's $14 billion in late fees at stake, fees that are either all going to go to the banks or some of which might be saved by the families. So, Director Chopra, industry lobbyists claim that these sky-high late fees are necessary, and here's what they say, to punish and deter borrowers so they will pay on time. Does your analysis support the lobbyist's view, or does it show that this is just one more junk fee that is mostly used to boost bank profits?
Our analysis shows that they have many ways to punish borrowers. They can jack up their rates. They can send them to put a bad mark on their credit report. They can even sue them.
Mhm.
So there's plenty of ways. And honestly, if it was not a major part of their profit model, our proposal allows them to collect back their costs. They should be supportive of that if it's not a core part of their profit model.
Thank you. So, in fact, the data show that companies make 5 times more from late fees than it costs them to collect late payments. So I guess it's no surprise that the industry lobbyists are out there going hard against this rule. They want to keep that money. Now, earlier this year, I wrote to 10 of the largest credit card companies, and I asked why their late fees were so high. Not one single company provided any evidence that they needed to charge $41 to deter late payments. In fact, Wells Fargo provided data showing that the late fees it collected exceeded the cost of collections by tens of millions of dollars. Now, meanwhile, we're also seeing record high interest rates for credit cards. Director Chopra, how much did credit card companies make in interest last year? Do you know?
It's roughly $105 billion.
Wow. And did credit card companies generally hike up their interest rates last year?
So we found that credit card companies increased rates far beyond the increase in the Fed funds rate, even as charge-offs declined.
So the Fed raised its rates, but the credit card companies raised their rates far higher?
Even as their performance was doing okay.
Okay, so here we are. We've got credit card companies that are raking in record profits, and they are determined to keep junk fees as one more way to make money, more than $14 billion here. I support the CFPB's proposed rule on credit card late fees, and I urge the CFPB to finalize this as quickly as possible. You know, getting rid of junk fees is just one more example of the CFPB working for the American people. So thank you, Director Chopra, for your work protecting older Americans. Thank you for your work protecting our veterans. Thank you for your work protecting active duty service members, student borrowers, and families all across this country. Thank you.
Thanks, Senator Warner. Senator Daines from Montana is recognized.
Chairman Brown, thank you. Dr. Chopra, thanks for appearing before the committee today. I continue to hear from folks across my state of Montana about the adverse impact your agency's actions are having, from increased compliance costs to one-size-fits-all mandates that just don't work in rural communities. It appears to me the CFPB under your leadership has become a political arm of the Biden administration, rushing through progressive actions that in many cases have bipartisan opposition here in Congress. One example of this is the 1071 rule, which I'll get to momentarily. But first, I want to start with credit card late fees. I saw Senator Warren was asking some of the same questions. In February, CFPB proposed a rule to reduce late fees that credit card issuers can charge customers. But your own data at CFPB shows that 74% of customers make payments on time and will not see any positive impact from this proposal. They will, however, see potential impact on increased annual fees, reduced rewards, lower credit limits, because prudential regulators require banks to offset the credit risk so as to maintain safety and soundness. Further, I have serious concerns that this rule will lead to more consumers paying bills late, which will in turn negatively impact their future creditworthiness. In other words, we're not going to, they're going to stop or lower the penalties paid for those who aren't paying bills on time in trade-off for increasing costs or reducing rewards for those who do pay on time. So my question is, why would your agency proceed with a rule that would potentially cause hardship to those it actually seeks to help?
So respectfully, that's actually not how the credit card business works. The way credit card underwriting works is it's an individualized interest rate. So it's underwritten based on your own individual data. They don't have one price or one rate that they give everyone and cross-subsidize amongst them. Our goal is to make sure that the Card Act is being followed. The Card Act prohibits unreasonable or disproportionate penalty fees. Our proposed rule, which we are still working through, allows a company, an issuer, to recoup. And as Senator Warren just mentioned, They just have to be able to show the math. And of course, it does not take away the ability of the card issuer to lower their credit limit if they're late, to increase their interest rate, or if they never pay, to sue them.
So let me ask you, as you say, you're still in the deliberative phase, perhaps, on this rule. To what extent did your agency engage with the prudential regulators while crafting this proposal?
Well, we certainly communicate and consult with the prudential regulators on these types of rules. In fact, I believe we may even be required to. There's many ways in which various banking regulations intersect with each other.
What kind of feedback did you get from those regulators?
I'm not going to, I need to really check because I'm sure we talk to each individual one as well as in a group. But I would generally say.
Do they have any concerns about it generally, or?
I would need to check. I'm happy to answer for the record for you. But as I said before, because the credit card industry doesn't have one price, it does underwriting. I think the effect that you're mentioning is unlikely.
But do you have like a top line summary? I mean, you said you have to check. I mean, it's pretty important feedback from the prudential regulators.
Yeah, I think the overall feedback is that it would not have an impact on safety and soundness of financial institutions.
Do you have any adverse effect on some credit card holders?
Well, I think, again, our consultation with them, I think, is on safety and soundness, but I'm happy to check and answer more for the record. And just so you know, I'm with you. I don't want to create a situation where, some people are incentivized to not pay, but we also need to make sure that this is reasonable. When I talk to smaller credit card issuers, they're not building a business model where they're rooting for their customers to be late.
Let me switch gears on the 1071, and thank you, Dr. Chopra. I've got serious concerns of the impact of your regulation of small businesses. In fact, something I hear pretty much across the board from folks back home, virtually unilaterally. I'm not alone because, as you know, a bipartisan majority of both the House and the Senate voted recently to scrap the rule. The final rule makes certain data reporting requirements optional, but you've also noted that low response rates could lead to supervisory problems for lenders. My question is this. I know that many small businesses are not going to want to report this data. So what will you do to ensure that lenders aren't penalized solely due to a low response rate?
Yeah, that's not the intent. In fact, no one is forced to complete this information. They have an absolute right to refuse it. But of course, if you think about it, we have to make sure that it's actually being provided and not saying, oh, you can just throw this out. So we're really trying to be reasonable about it.
Okay. Mr. Chairman, thank you.
Thank you, Senator.
Thanks, Senator Daines. I believe no one else is coming, so thanks, Senator Daines. I have one more question, then we'll adjourn. About big tech, we know that people have major concerns about how much control over American lives and information big tech enjoys, encroaching on our financial lives too. We're seeing digital payment products serve as a substitute for traditional bank accounts, but we know that new tech doesn't have the same consumer protections and oversight that traditional banking does. What are you doing to ensure that big tech offers the same consumer protections as traditional banking services?
Well, like I said to your colleagues, too, we do not want to see the market move just by exploiting loopholes or regulatory arbitrage. So if we have very, very large firms competing in the same market, we want to make sure that they're held to the same standards as the medium and small sized banks. We've seen issues with some of these apps that the money may not be insured. We've seen other places where the data is being harvested. So I do think we all need to be careful and make sure that those large tech firms are playing by the same set of rules.
Okay, thank you. And Senator Warnock's on his way, so I have one more question. I'm concerned about the risk posed by AI and in lending decisions. CFPB recently issued guidance reaffirming that current laws apply to credit denials, including those utilizing artificial intelligence. Specifically, you all reaffirmed that financial institutions are required to provide accurate explanations for adverse actions like credit denials. How is CFPB ensuring that these explanations faithfully reflect the actual reasons for the credit denial when AI is used?
Yeah, one of the things we've done is making sure that it's clear there is no fancy technology exception to federal law. Federal law requires you to inform a consumer about the reasons for an adverse action or denial. You can't make up the reasons. You can't just put it in a form if it's not true. So we will be making sure that when there's uses of AI or other technology, that it's not sidescaping existing law, and we'll be using our authorities to make sure that people are complying.
Okay, we'll hold for a minute. Senator Warnock is close. Or do you want to do another question?
Senator, may I address a previous question that was, I really respect actually, Senator Vance's concerns. I do want to be clear that the Justice Department CFPB statement actually affirmed that creditors can use immigration status when lending, but of course they have to avoid national origin discrimination. And of course, all of the authorities under the Bank Secrecy Act, anti-money laundering, to ensure that that they know who that person is. And for non-U.S. persons, the Bank Secrecy Act requires certain documents. Again, immigration status, according to the guidance, can be used, but just not with illegal discrimination against national origin. We have seen in our recent enforcement action against Citibank a whole and in some ways deliberate attempt to discriminate against Armenian Americans. Citibank essentially denied people with the suffix of the last name of Y-A-N and I-A-N, and then provided them notices, essentially fabricating the reasons for denial. So all we're trying to do is make sure that we're in accordance with the law and faithfully enforcing the prohibition on national origin discrimination.
Okay, another comment again, awaiting Senator Warnock is on the way. You had said in a response to Senator Brett that you would be willing to meet with Alabama community bankers. I'd just like to put out there that there may be a number of people in this committee would make the same request, and that you honor it for whatever state, large and small, that community bankers want to meet with you, that you would be willing to do that.
Yes, and in fact, I may have beaten you to it. I believe that I've reached almost all 50 states when it comes to either their state banker association or credit union association, but if we've missed anyone, we'd be happy to.
Okay. And in Ohio, the community bankers, for as long as I've been on this committee, 15 years, have come to meet, usually in this room. In Ohio, there are maybe 100 that come, and there may be 40 or 50 from credit unions, and you've always been open. I don't think you've come specifically to meet with them, but I may call on you that later.
Of course. We have, my staff is sharing, we met with the Alabama Bankers Association in September of 2022, and also the Southeastern Credit Union League, which includes Alabama, Georgia, and Florida, also in 2022.
Okay, one last question. I normally don't end the committee this way, but I have special request. Talk about your work with allotments and service members.
Yeah, so allotments, just so everyone is aware, this is where a consumer is really paying for an obligation through the DoD payroll system. So DoD's payroll system allows an active duty service member to identify certain payees. This is really to assist them if they're away or if they are, unable to manage their finances to not miss out on bills. Over the years, we have seen some lenders and others abuse that allotment system. We have been working with the DoD over time to make sure that the allotment policy is not an invitation, for predatory actors and scammers. I actually worry about this, Chairman Brown, too, because there's a lot of surveillance on service members and their families. A lot of information is collected about them, targeted, and I think that is something that raises a lot of risks in how they might be manipulated or otherwise harmed.
Okay, did you, speaking of that, you may have heard my opening statement. I think you appeared to be listening about Title Max. And
yes.
Any elaboration on that, the several $1 million fine and
yes,
the size of the company and what they might be doing?
And restitution. I don't have the exact statistics in front of me, but there's been several actions we've taken, First Cash, Title Max, others, specifically related to the Military Lending Act or, other perpetrations of fraud or misconduct against service members.
Okay. Senator Warnock of Georgia is recognized.
Thank you so very much, Mr. Chair. Under your leadership, the CFPB has done a lot to address the burden of medical debt that families fall into as a result of illness or unexpected trips to the emergency room. This issue matters because so many Americans are crushed under high health care costs, and they usually don't have a choice about whether or not they need that medical attention, whether it's in the budget or not. Sometimes you just need to go to the doctor. And this is particularly true for those who are living with diabetes, especially in a state like Georgia that sadly has not expanded Medicaid. And as a result, many of the counties in Georgia are a part of what I call in a recent report released by my office, insulin deserts. We released this bipartisan report earlier this month. There's some 813 counties all across our country with high rates of Americans who are uninsured and they have diabetes. And thus they are left unprotected from high insulin costs and particularly vulnerable to medical debt. In fact, in preparation for this hearing, my office found that 365 insulin deserts, nearly half, also have high rates of medical debt. So Director Chopra, what is the CFPB doing to address medical debt, particularly unfair medical debt collection and credit reporting practices? I know that we've already had some conversation about that today, but 813 insulin deserts or counties across our country, a lot of them in Georgia and all across the country. So these are folks who are dealing with a chronic disease, and we're seeing the impact of that on them both in terms of their health, but also financially. And so as you think about a disease like that, if you'd say a little bit more about your work addressing this issue.
Well, I think we've all been able to see some of the individuals. I recall one teenager who overheard his parents struggling financially because of his insulin expenses. I think he was 13, and he decided to self-ration because he was worried so much about his parents and their financial situation. In my past work, looked hard at the issue of potential price fixing by insulin providers. I think when we talk about medical debt, we also have to remember that this might ultimately lead people to not get care that they need to live. When a teenager is self-rationing insulin and then hospitalized, we know we have a system that is not working. And then on top of it, Senator, when I went to Georgia and met with, some of your constituents, one was Liz Coyle, talked about how medical debt is affecting people locally. And really, it is now the largest item of delinquency on credit reports. We have studied this exhaustively, and we are currently initiating the process to, we may end up proposing that medical debt be ineligible for reporting on credit reports, given the unique dynamics and the widespread inaccuracies. I really hate to see that medical debt, especially when people are sick, being forced to pay even when they may not even owe, almost coerced to pay it, and we want to really address that.
But on the question of rationing that you raised with this particular 13-year-old, about 1 in 4 folks who are on insulin, 1 in 4 in our country, have reported that they've rationed their insulin at some point or another. And so I'm interested in exploring how Congress can work with CFPB to protect consumers, especially those with chronic illnesses, from medical debt. So thank you for your work. I think that as a start, we can pass my bipartisan bill that I put forward with Senator Kennedy and others to cap the cost of insulin for everybody. That would help prevent people with diabetes from going into medical debt in the first place. And I look forward to continuing to work with you on this important issue and exploring medical debt more in my subcommittee in Congress. Thank you very much.
Thank you, Senator.
Thank you, Senator Warnock, and thanks for your comments about medical debt. We've had a number of conversations privately and publicly on this committee. As you know from our hearing with you had a really good term with the rating agencies. You used what word did you use to describe the rating agencies?
Well, the three conglomerates.
The conglomerates, yeah. Thank you for that, and we will continue to bring them in and continue to work with Senator Warnock and others to get get medical debt off of credit reports. So thank you for that. Senators who wish to submit questions for the hearing record, they're due 1 week from today, Thursday, the 7th of December. Witnesses, please submit your response. To the witness, please submit your response to questions for the record 45 days from the date